Good day, ladies and gentlemen, and welcome to the State of Health Insurance 2017 webinar. All lines have been placed on a listen-only mode. If you'd like to submit a question at any time during the webinar, you may use the Q&A box at the bottom left-hand side of your screen. Simply type your message and click the Ask button. If you should require assistance throughout the conference, please press *0 on your telephone keypad to reach a live operator. At this time, it is my pleasure to turn the floor over to your host, Rachel Morgan. Ma'am, the floor is yours.
Thank you. Good afternoon and Happy New Year, everyone. I'm Rachel Morgan, Senior Committee Director for NCSL's Health and Human Services Committee and a member of the State Federal Relations Team in the Washington, D.C. office. I and my colleagues in our Denver office will be facilitating today's webinar.
Thanks, Rachel. I'm Dick Kauke, a Program Director in Health based in our Denver office. And on behalf of the National Conference of State Legislatures, we'd like to welcome all of you today to today's webinar, The State of Health Insurance 2017. We'd like to remind participants that NCSL is a bipartisan membership organization of state legislatures. NCSL provides policymakers the opportunity to exchange ideas and advocates for interested states on the federal level. This webinar is a platform for information exchange. We encourage a robust Q&A at the conclusion of the presentation and remind participants that they can submit typed-in questions at any time during the webinar at the box on the lower left. Also, select materials from today's webinar are available on the NCSL website and within this webinar site. Speaking of using materials, a word about NCSL's meetings and webinars. These are open to the media and other invited guests. However, use of any information or graphics must be approved through NCSL's Public Affairs to ensure proper crediting. All individual slides with authors or publishers or copyrights on them remain the property of the original owners or NCSL. Before we introduce today's impressive panel of speakers, we want to especially thank the NCSL Health and Human Services Committee for sponsoring today's webinar. We all know that 2017 will bring significant high visibility changes, options, and challenges to health insurance in the United States. NCSL is hosting this federal and state-oriented look at the present and future of the private insurance market. Just to clarify before I turn this to Rachel, that your questions, again, can be entered at any time, but through that Q&A box that you see on the lower left. With that, Rachel Morgan.
Since the enactment of the Affordable Care Act in 2010, an additional 20 million individuals have actually gained coverage, marking the lowest uninsured numbers the country has experienced. However, the rising cost of premiums and other problems that have been associated with the system that was created by the ACA led to it becoming a major campaign issue during the 2016 presidential election. The incoming Trump administration and congressional Republicans have made it clear that changes in our health coverage system is a guarantee. Vice President-elect Pence actually has had a meeting with congressional Republicans this week and has asked Congress to get legislation repealing the ACA to the new president's desk by February 20th. Repeal and replace of the ACA has been designated as their first order of business after coming into office. The biggest question is what a replacement for the law would look like and how it would impact access to insurance and health coverage systems in the states. And it's my pleasure to say that today we have three national experts who will discuss the impacts on marketplace stability during 2017, state roles in securing access to coverage for their citizens, affordability of coverage, and state regulation of health insurance. We'll also discuss some of the latest developments that relate to the presidential transition and how changes by the new administration and Congress may unfold. And I'll advance the slides here. Our first speaker today is Brian Webb. Brian is the Assistant Director of Health Policy for the National Association of Insurance Commissioners, who represents the insurance regulators in all 50 states. His extensive experience in the field includes Medicare and Medicaid policy and work with various health systems. Our second speaker is Kim Holland. Kim is a Vice President for State Affairs for the Blue Cross Blue Shield Association, who represents the 36 independent, community-based, and locally operated Blue Cross and Blue Shield companies. Kim is a former insurance commissioner from the great state of Oklahoma and has also served on the state's Employees Benefit Board and Medicaid Authority. And our third and final speaker today is Professor Timothy Jost. Professor Jost is an emeritus professor at the Washington and Lee University of Law. He is also a member of the National Academy of Medicine and a consumer liaison representative to the NAIC. I'll now turn it over to Brian.
Thank you, Rachel. I appreciate that, and always appreciate the opportunity to come and speak to the NCSL. I'd like to start today by just kind of looking at fundamentally what did the Affordable Care Act do? And really it reformed mostly the individual market, a little bit of the small group market as well, but just how insurance is created, what it does in the United States. Now, no longer could carriers avoid risk through underwriting or through pre-existing condition exclusions or coverage limits like annual or lifetime limits, or by benefit design. Prior to the ACA, there were many states where individual market plans did not cover mental health, did not cover maternity coverage, prescription drugs. So those were just ways to design the plans, to market the plans so that to avoid certain kinds of risk. Now, second part of that is the plans could no longer price for risk either. So you could not price for people based on the fact that they're coming late into the program or they have a pre-existing condition or health basis or anything like that. So as you can see, you're really limiting the ability of carriers to set their price and decide who they're covering. And really what that's done is fundamentally change how they operate. For now, carriers are really the only thing they're really competing on is being able to manage risk and improve quality and service. So that fundamentally is what the ACA did, and as we have seen, that transition has been, I think everybody would agree, very difficult. And what commissioners are seeing out there, and I'm sure you're seeing it as well, as you talk to your carriers, you talk to your providers, talk to your consumers and business people, we're seeing some real troubling trends in many states in the individual market. One, of course, is carriers pulling out of the exchanges or out of the individual market altogether in a state. So we're seeing fewer carriers providing coverage and got very close in a few counties of having no carriers providing coverage on the exchange or even providing any coverage in the individual market. And that's troubling. People need to have some options. We've also seen service areas with only one carrier. So there may be some, but sometimes it is only one. We've also seen fewer coverage options. And this is very much a growing trend where there may be carriers, there may even be multiple carriers, but everybody's only offering HMOs or very limited network-type plans. So people, again, are very limited in their options. And, of course, what we've all heard is some unstable premiums. While over the first couple of years of the ACA, you saw kind of a slower growth in premiums for 2017, saw them shoot up quite a bit in some states. And that, of course, is very troubling for people, especially those who are having to pay those extra premiums. Now, on the other side of it, of course, we have seen, as was mentioned by Rachel, lower uninsured rate, which has been a good thing for consumers as well as for providers and others. But these trends still are very troubling to insurance commissioners, as well as I'm sure to all of you. When we look at kind of why these things are happening, we can kind of break it down to four basic problems that we see. One is, of course, just the unsustainable cost growth of health care. This is something that's not really addressed as part of the Affordable Care Act, something some states have tried to address. I know a lot of people would like to address, but the fact is health care costs keep going up, and utilization of health care keeps going up. And, of course, that has a direct impact on premiums. Another side of it is the unstable risk pool. The whole idea of the Affordable Care Act was, since we're going to put the carriers in a position to have to cover everybody, of course you're going to use individual mandates, subsidies, and other kind of things to make sure everybody's in and you have a stable risk pool. Everybody will know what they're covering, and that really just has not occurred. We still have a lot of young healthy staying out of the marketplace. We had the transition plans that were allowed by many states staying outside the pool. Of course, you still have your grandfathered plans as well. The decisions by states, and again, not saying good, bad, or indifferent on those decisions, they just have an impact, but things like whether to expand on Medicaid just had an unstable impact on the risk pool. So that's something that is still part of that transition, still a problem. Adding to that was the unreliable funding. In fact, the programs that were supposed to deal with the unstable risk pool corridors, insurance, risk adjustment, became the unstable funding that actually caused more problems. So as we've had concerns about reinsurance and the possibility that some funding may be given to Treasury, we had the risk corridor, billions of dollars that was cut from the program in the middle of the program. As we had risk adjustment, people, especially smaller carriers, were unable to really get an idea of what they were supposed to be paying. All of these things added to the overall instability of the individual market. And then the thing we focus on quite a bit, as you can imagine, as state regulators, is uncertain regulatory environment. Just constant changes in the rules, constantly interpretations of those rules, constant uncertainty about whether it's the state rules or the federal rules, difference of definitions and data requirements, all have added to an environment where there's just a lot of instability, and that has led some carriers, again, to leave, other carriers to stay but raise their rates or change the kinds of plans that they're going to be offering. So all of that leads us now to 2017, and really the question is what's going to happen this year. Obviously, there can be legislative changes. We have a Congress, House and Senate, as well as an incoming president who said they want to make legislative changes to the Affordable Care Act. That could entail a repeal, could be a repeal and replace, could be just significant amendments to the Affordable Care Act. And the thing that we're really looking at as state regulators is the big question of when. Not only what they may do, but when they may do it. As we sit here in January 2017, I'll tell you, carriers are already preparing their plans and their rates for 2018. State regulators are already preparing based on the current rules, preparing for 2018. So what changes would be made this year that could impact 2018 or 2019 and when those would go into place, or 2020 and when those would go into place. So we're watching very carefully the legislative actions and when those may occur and be put into place. Also, we're looking at regulatory changes. What can be done from a regulatory standpoint outside of a legislative decisions by the administration to change rules, change interpretations, so as to stabilize the markets or provide, as the incoming administration has said, more state flexibility to the waiver process or state flexibility in the oversight and enforcement side. And then just how can we improve the regulatory environment? Less requirements, less oversight, less conflicts. How can that be improved this year, even to make improvements for 2018 and beyond? Then you have the waiver process. And again, the last administration did have rules on waivers, on how they would be put into place. Will they change those rules? Will there be more willingness to grant waivers? We will see. And then finally, the other thing we're going to be watching very closely is lawsuits. And I think other speakers are going to talk a little more about one in particular, the House v. Burwell. But there are still lawsuits out there. In fact, this past week there was an injunction placed on the Section 1557 non-discrimination rule, certain provisions of that and that could impact going forward. So we're going to be watching lawsuits as well to see how they could impact plans for 2017, 2018, and beyond. Now, where does that leave states? Well, as state regulators, they're very used to you enforce and implement what's currently the law. So states, until told otherwise, state regulators will look to 2018, looking at forms and rates as they come in, and they will do oversight and enforcement for the 2017 policies based on the current rules, and then review and approve policies for 2018 based on current rules until there is some kind of change. But the big thing is really states need to be monitoring the federal government, because if there are changes, the question becomes what changes then need to be made to state law and to state regulations. Some states have adopted in state law some of the ACA requirements. They have adopted into regulation some of the ACA regulations. So as these change, what changes need to be made at state level? And again, that big question of when will those changes be made at the state level? And then finally, states should consider what other options as waivers are a possibility. If there's changes to the rules on waivers, do you want to submit one? And also with any increased state flexibility, what will states do? So this is all something that states will have to monitor very closely, and I know the industry will be monitoring closely as well, as will the consumers, the providers, and everybody, because everybody's impacted by what happens this year. So with that, there's my contact information. Contact me anytime, and I will now, I think, give it over to Kim Holland.
Thank you very much, and thank you for the invitation to join you here this afternoon. I'm sure that there's a wide difference of opinion among state legislatures as to the Affordable Care Act, just as there is among the American people generally. And I think we've heard from Brian and Kim in the last few minutes some of the problems that insurers and insurance regulators have experienced from the Affordable Care Act, and I don't gainsay those. On the other hand, it is clear that the ACA has dramatically expanded insurance coverage in virtually every state, as you can see from this chart that shows coverage expansions from 2013 to 2015, with the states becoming lighter and lighter as coverage expanded. It has also expanded access to care. There we go. As this slide shows, that in 39 states, fewer adults are going without care because of cost, because of the Affordable Care Act. Precipitous repeal of the ACA through reconciliation, including both the marketplace provisions and the Medicaid expansions, would result in an increase in the number of uninsured, as this slide shows, from 8.9 to 58.7 million individuals, an increase in the uninsured of 30 million. Repeal of the ACA would also impose a $1 trillion burden on the states and providers over 10 years in the burden of uncompensated care. Also, a report came out this morning from the Commonwealth Fund, which unfortunately it was too late for us to get a slide up, looking at the specific economic impact of repeal on the states. And that projects that repeal of the Affordable Care Act without any replacement would result in 2.8 million jobs being lost and a loss to the states of business input over 5 years of $2.6 trillion, loss of gross state product of $1.5 trillion, and loss of state and local taxes of $48 billion. But we're not really talking, I don't think, about total repeal. We're talking about repeal and delay. a repeal of the key access and affordability provisions of the ACA, such as the premium tax credits, cost-sharing reduction payments, and Medicaid expansions, probably with a delay of 1 to 4 years in the effective date of repeal while awaiting a replacement plan. While repeal and replace would seem to preserve coverage from disruption, in fact, it will only do so if the individual market remains stable, and in particular if insurers continue to participate in it. I would emphasize that what is at stake here is not just the stability of healthcare.gov and the State Affordable Care Act marketplaces, but of the entire individual market. The entire individual market is a single risk pool, and if the marketplaces collapse, the remaining individual insurance market would probably not be viable, at least for insurers offering comprehensive coverage. So we're not just talking about low and moderate income people losing coverage, but we're talking about perhaps 7 million additional farmers, ranchers, self-employed people, and small business people who have long relied on the individual market for coverage, losing their coverage. I would also note, as Kim already said, that the individual market is a very small part of the business of the large commercial and blue plans, which are much more dependent upon insuring and administering group plans and on Medicare and Medicaid managed care, and do not need to stay in the individual market for their own business survival. The stability of the individual market was already under threat before the change in the administration. Initial underpricing of coverage and apparently higher cost than expected risk pool caused insurers in a number of states to raise their premiums dramatically for 2017, and several insurers to leave the marketplaces, as we've already heard. A recent report by S&P Global, however, indicates that insurers are moving back towards stability and that increases for 2018 should be smaller than 2017. But for the individual market to stabilize for 2017, several hurdles have to be surmounted. We seem to be clearing the first hurdle, ensuring a large enough individual market enrollment to provide a viable risk pool. As of December, and I think that slide got slipped in earlier. I'm sorry, I tried to exchange a slide yesterday. As of December 31st, 2016, 8.8 million individuals have selected marketplace plans or been auto-enrolled. Counting the state marketplaces, this means we now have 11.4 million confirmed plan selections. We don't know much about the age or risk profile of this market, but the more enrollees, the more likely it is that we will contain healthy as well as unhealthy enrollees in the marketplace. And right now, enrollments are running ahead of last year. Significantly, all the talk about repeal does not seem to be dampening enrollment in the marketplaces. The second hurdle in marketplace stability is what Congress does. Congressional leaders have already begun the budget reconciliation process to begin repeal. They will presumably pass a budget resolution, which they're debating right now sometime next week, directing jurisdictional committees to report repeal proposals by January 27th. They will then compile the committee reports and then pass a reconciliation bill sometime in February. Right now it looks like Congress will repeal parts of the legislation, but delay repeal for the coverage expansions for some period of time while they try to come up with replacement. If Congress proceeds with repeal or replace on a very short time frame, or, God forbid, repeals without replace, it's going to make insurance markets very nervous. The third hurdle to marketplace stability is the potential fallout of House v. Burwell, which both Brian and Kim have already mentioned. This lawsuit claims that the money that the federal government is paying to reimburse insurers for reductions in cost sharing, which the insurers are legally required to make for low-income marketplace enrollees, that those payments are illegal as the funding has not been appropriated. The Obama administration has insisted that the money has been appropriated, but the lower court ruled for the House and the Obama administration appealed. The House has delayed this lawsuit, asserting that the Trump administration may be willing to settle, but a motion to intervene has been filed on behalf of the 5.9 million cost-sharing reduction recipients affected by the lawsuit. If the cost-sharing reduction payments are terminated, which I suppose could happen as early as March or April, the insurers would be left holding the bag for $9 billion, as Kim said, and many would likely leave the marketplaces, again, possibly leading to the collapse of the individual insurance market. The clearest sign as to marketplace stability will be whether insurers show up for 2018 in May, when insurers must file their rates and forms for 2018, and what level of rate increase they will request. As Kim noted, insurers must file their applications for qualified health plan certification by May 3rd, but have until mid-September to make a final decision as to whether they will participate in the marketplaces. Insurers that intend to withdraw from the entire individual market must give 180 days notice to enrollees and state regulators. So if insurers are going to give up on the individual market, we'll probably know by midsummer, if not earlier. As all of this shakes out, I think there are a number of issues states should be focused on. First, what will happen if Congress allows sale of insurance across state lines, which is something that President-elect Trump has said he favors and shows up in some replacement plans. While much of the talk of Congress has been about returning regulatory authority to the states, allowing sale across state lines does exactly the opposite. It deprives state legislatures and insurance regulators of the authority to govern their own insurance markets. It has been opposed by the NAIC for this reason. Moreover, sale across state lines, in fact, doesn't work for insurers. A number of states already allow sale across state lines, and a form of it was included in the ACA. But health insurance depends on local networks, and insurers have just not found selling coverage in markets in which they are not licensed to be profitable. Nevertheless, federal preemption of state laws requiring insurers to be licensed in-state to sell insurance could undermine state regulations. Second, a number of the congressional proposals and the Trump administration's proposals would transfer more regulatory authority to the states. Indeed, the easiest replacement proposal for Congress to adopt, although I haven't heard them talking about this lately, would be to simply repeal the ACA but say that any state that wants to can keep it, and the other states can do whatever they want or choose from a menu of options. If states are given responsibility to regulate insurance, but no money comes with this responsibility, however, this could be a mixed blessing. For example, there is a lot of discussion right now of high-risk pools to provide coverage to high-cost enrollees. Prior to the ACA, 35 states had high-risk pools. Some of them worked okay, but most of them were subject to chronic underfunding. Premiums and cost sharing were high and benefits were skimpy. Enrollment at the time of the ACA was adopted was under 250,000, as this chart shows, only a tiny fraction of the uninsured. The Urban Institute estimates that covering everyone who was uninsured prior to the ACA with a chronic medical condition in state high-risk pools would cost $178 billion a year. One of the proposals before Congress would provide states with $1 billion a year in funding, others $2.5 billion. The urban estimate is probably high, but $1 to $2 billion a year is going to leave most of the costs of high-risk pools on the states. Third, much of the ACA, as this map shows, is already baked into state law. If the ACA were repealed today, most of the market reforms would remain in the law in about a third of the states. Another third of the states have adopted at least one of the ACA's market reforms. State rate form and market conduct review in most states is based on ACA requirements. The SURF system, which is widely used for the states for rate and form review, has been extensively modified to incorporate the ACA. The 46 states in which the federal government relies upon the states to do some or all of enforcing of the ACA would have to amend state laws, regulations, and programs going forward. Replacement of the ACA must leave states time to modify their laws, regulations, and programs. And I would note that states and the federal government had 4 years to implement the ACA before the switch was flipped in 2013. And at that point, a lot of things didn't work. And so I think the idea that we could just replace the ACA in a year or two is pretty hard to swallow. Finally, the individual market for major medical cover, if the individual market for major medical coverage collapses in the next year or two, the vacuum will be filled with products that are not required to comply with the Affordable Care Act market reform requirements, such as short-term coverage, fixed dollar indemnity coverage, specified disease policies, and discount plans. These types of coverage are not subject to the ACA's ban on health status underwriting or pre-existing condition exclusions, its out-of-pocket limits, its ban on annual and dollar limit and lifetime dollar limits, or other reform requirements. But if the market for comprehensive coverage collapses, they may become widely available, and they certainly cost less for the young and for the healthy. They could take over the non-group market. This coverage is subject to few state regulations. You might consider taking a closer look at regulating these products to ensure at least that consumers understand what they are buying and get some value for their money. They could conceivably be all that you have left. So that's my remarks, and now I suppose we turn to questions.
Yes, thank you, Dr. Jost. And thanks to Kim and Brian for their thought-provoking presentations. We really do appreciate it. But before we move on to our question and answer period, we'd like to get some information from you. And I'm going to turn this over to my colleague, Ashley Noble, who's going to direct you through a poll question.
Hi, everyone. So for our first poll question, we want to know which of the following choices that you see on the screen is most important in your state. That's not. And while we're working on this poll, I wanted to mention that if we can't get to your questions while we're live, we can provide offline responses, especially if you send it to the email addresses listed on the last two slides of this presentation, which are coming up shortly. Also, when you ask your questions, please be sure to type in your state. And a few of you submitted questions near the beginning of the webinar. If you could do us a favor, please resubmit these questions with your state added so that we can, have a better idea of how to respond and who we're responding to. Great. It looks like we've got some really good responses here. Roughly the same number of people have chosen A and C. Maximizing the number of people who hold health insurance and controlling the overall cost, controlling the cost of overall health spending. C is now up by 2%. And I think with that, we will open it up for our Q&A session. So please enter your questions in the Q&A box at the bottom left hand of the screen, and we will ask our speakers to address them.